Hello and welcome back to a new season of the Author's Note. I hope 2014 is going well for you so far. Now, a few years ago there was a very popular book called The World is Flat, suggesting that globalisation meant that the world had become flatter, that countries were ever more closely linked thanks to economic links. Today we in the FT have some very interesting research done in conjunction with McKinsey suggesting that that isn't as true as it once was. With me now to discuss this is our capital markets editor, Ralph Atkins. Ralph, thanks for joining us on this side of the divide for today. Let's start by taking a look at this very ambitious graphic that you've put together with McKinsey. Take me through what's going on here.
What we've plotted is the volume of cross-border flows flowing between basically the G20 economies, which we took as a proxy for the world.
So that includes all the biggest emerging markets
yeah,
as well.
Yeah, it's about 75% of the global GDP, and we're looking at different types of flows, debt markets, equities, and other investment, crucially, that's basically bank lending mainly, okay. Yes. And what you see, of course, is that after the collapse of Lehman Brothers towards the end of 2008, we had a massive contraction.
Primarily a credit contraction, judging by those yellow bars, right?
Yeah, absolutely.
That was the credit crunch right there.
That was the banks withdrawing back behind their national borders, not lending overseas anymore. We had a bit of a recovery in 2010 and 11. Then came the Eurozone crisis, which hit, of course, European banks particularly hard. And what we've seen then is a contraction again. And if you look at where we are now in terms of total cross-border capital flows, we're perhaps only slightly better than we were
in 2001, just after 9/11, during the Enron and WorldCom scandals.
And if you do it as a share of GDP, to sort of take account of inflation or whatever, we're actually a bit below where we were a decade ago. So globalisation gone into reverse? Question mark.
Well, certainly not moving full speed forward at the moment by these numbers. Right?
Absolutely, yeah.
Now let's take a look specifically at the Eurozone, which has obviously been the centre of concern for a while now. Now again, we can obviously see a very pronounced credit crunch after Lehman. What's intriguing is we can see another one going on now. Take me through this.
Yes, I mean what we see obviously here is that the point I mentioned about European banks contracting. What we're seeing is that the inflows by foreigners of capital or lending or loans is actually gone into reverse. So banks are withdrawing their money out of Eurozone countries and retreating behind national borders, which is fueling the credit crunch. And it raises the whole question about what this means for economic growth prospects in Eurozone countries if we aren't getting the level of capital flows we were before.
So is Europe in effect becoming balkanized into its constituent countries, even as they're trying to sort out a banking union?
Yes, absolutely. And then obviously this has an impact on lending to particularly SMEs and job creation and funding for investment. But of course, it's a two-sided argument, of course, because what we had before the Eurozone crisis was massive inflows into Spanish property, for instance, which ended up causing the crisis. So what the optimum level is for capital flows, I don't think anyone really knows.
Well, I think we know that it's higher than where we are now and considerably lower than it was back up in 2007
that
when
would be
it blew up the property bubble.
A reasonable assumption, yes. But and also, what's the optimum mix? I mean, bank lending, is it maybe too short-term, too speculative, too easy to remove, too hot, if you like? Foreign direct investment, is that a better type of capital flow, arguably longer-term, more stable?
Okay, but what we've seen here in terms of foreign direct investment, if just briefly, although we don't have this graph, when it comes to emerging markets, are we seeing primarily portfolio flows into emerging markets or foreign direct investment?
Foreign direct investments become much more important as a share of the total globally. And it's remained remarkably steady as well, and that goes for emerging markets as well.
Okay, Ralph, thank you very much indeed. It's a very interesting report. There's a lot more of it on ft.com and in the printed paper. I suppose one final investment outcome I would make from this is that geography, for a while before and during and immediately after the crisis, barely mattered at all. Lots of different countries moved absolutely in line with each other. Now that money is tending to stay at home, geography matters a lot more. That was certainly the case in 2013. We can expect it to continue to be more important than it was.